Hello, this is Thami Kabbaj. Welcome to this new course, The Psychology of Trading, the Key to Success. Learn how to manage your emotions. Detailed plan, part 1. Trading psychology is the main reason for failure in trading. The market chaos encourages irrational decisions. The dangers of knowledge and beliefs in trading. The influence of emotions during decision making. Dynamic psychological biases and the main errors you should banish from your trading. So basically, we will really study the main reason for failure in trading, and it is important before studying part 2, the optimal state to operate on the markets. So 1, manage your emotions and acquire particular qualities. 2, trading is not a natural process. 3, the trader must accept responsibility for his decisions. 4, how to perform at the best level. 5, what you should learn from the best traders of all time. Part 3, strive for excellence in trading. Like for sports or any other activity, you have to strive for excellence. Number 1, why is it so difficult to succeed in trading? 2, how to become a top trader. 3, develop a strategy to become a champion. 4, are great traders born? And 5, comments on some of the best traders of the 20th century. First part, trading psychology is the main reason for failure in trading. Presentation. Psychology is probably the most critical dimension in trading. It alone may determine failure or success. A brilliant analyst who manages his emotions poorly will never last very long on the markets. Therefore, it is key to understand the main reasons for trading errors. Chapter 1. The market environment may encourage irrational decisions. Plan. 1. The hostile environment may trigger irrational decisions. 2. The main excuses given by losing traders. 1. The hostile environment may trigger irrational decisions. Why financial markets may lead to irrational decisions? First, it is an unlimited environment. It's really unlimited. You can do whatever you want on the markets. 2. The search for certainty. 3. Dependence on random awards. And 4. Total freedom. We will study these elements. So, number 1, the unlimited environment of the markets. Markets offer an unlimited environment. No beginning, no middle, and no end for a position. You have to choose the beginning. So when you open a position, how you manage it, how you exit it. This is not the case even at the casinos. So we can understand the difficulty of financial markets. The trader will have to choose the time to buy a stock, to sell it, or to do nothing. This is an uncomfortable situation because in a regular job, the environment is structured and we have control over the situation. This is not the case on the markets. The search for certainty. Problem. Stock movements are random, so they can do whatever they want. Despite this, most traders are looking for a sure thing, a trading system with no losing phases. We can remember LTCM, so it's a huge hedge fund that was managed by Nobel Prizes, and these guys, they wanted to find a sure thing. They wanted to invest this. They thought they found something, a perfect system that will enable them to win whatever the market's conditions are. Kerviel is another case, so it's interesting case because also when he talked about what he was doing, he said, I had a sure thing, but there is no sure things on the market. And last but not least, quantitative funds. Also, many are trapped by the sure thing problem. So the myth of the alchemist is here to last. Dependence on random rewards. Financial markets attract thousands of amateurs every year. As for casinos, the whole industry is based on dreams of instant fortunes. Individuals have a real need for adrenaline that they believe the markets will allow them to satisfy. This approach may have harmful consequences. The addiction phenomenon is often present in the financial markets. Trading attracts many individuals for the wrong reasons. Many individuals want to become traders for the freedom it may provide. Possibility of unlimited earnings without having a terrible boss. You can choose your hours, you can work few hours, you can live wherever you want. However, financial markets are a somewhat unstructured environment where everything is possible. The trader is free to buy, to sell, or to do nothing. Problem: the total freedom sought by individuals does not encourage them to set rules, and even less to respect them. Financial markets are a dangerous place. They may trigger many psychological biases that you did not even imagine. 2. How traders justify their failure. Reason often mentioned by traders to justify their failure. The first reason is conspiracy theory. It's really popular. Second one, limited capital. Third one, the volatility or irrationality of the markets. That was the case of Julian Robertson, a very famous hedge fund trader who managed the Tiger Fund. And 4, the markets are not volatile enough and offer few opportunities. So, conspiracy theory. Markets are manipulated. So basically, when you meet a trader that is losing money, he will tell you markets are manipulated and I cannot make money because there is a conspiracy theory. In fact, it is very difficult to manipulate a market in the long run. Paul Tudor Jones said it really nicely. Manipulation is possible in the short run, but not in the long run. And there was this case study, the Hunt brothers. I don't know if you've heard about them, but Hunt brothers were very powerful in the 70s on the silver market. They tried to corner the market, basically to have a huge position on the silver in order to control prices. What happened to them is that there was a new law, they lost everything and they were ruined. So basically, is it possible to manipulate the market? Yes, it is possible to do it in the short run, but in the long run, it is quite impossible. And last but not least, where are the customers' yachts? It's very interesting because the thing is, when Fred Schwed, so basically he was talking about a client or a guy who went to New York and he was watching the yachts of bankers, brokers, and then he answered his guide, where are the customers' yachts? Basically, we have the yachts of the brokers, we have the yachts of the bankers, but we don't see the yachts of the customers because brokers are making huge amounts of money, bankers also, and the clients are losing money. So basically, what I mean by this is that you have to be very good in order to make it on the markets. You have to be really disciplined, and if you are like a herd, you will never make it. So there is no conspiracy theory, there is no manipulation, but the manipulation is yourself. Basically, you are the reason for your own failure. Markets are too volatile. So this is a very interesting quote of Julian Robertson. As I said, he was the hedge fund manager of a very famous hedge fund. And I will read it because it's really interesting. As you have heard me say on many occasions, the key to Tiger's success over the years have been a steady commitment to buying the best stocks and shorting the worst. In a rational environment, this strategy functions very well. The purpose in an irrational market where earnings and price considerations take a back seat to mouse clicks and momentum, such logic as we have learned does not count much. What happened to Julian Robertson? Because now he's talking about an irrational market, and he said in a rational environment, this strategy functions well. Basically, the strategy that consists of buying undervalued stocks and selling overvalued stocks. So in a rational environment, that is great. But in an irrational environment, it's not the case anymore. But I would like to say to Julian Robertson, the markets are often irrational, and you have to understand it. So it's quite weird that a great hedge fund managers do not understand it. Psychology was always on the markets. It's not something new. It always existed. So it is important for you to understand it and not to be trapped by these reasons and say, okay, I'm not making money because there is a conspiracy theory, because markets are too volatile, they're not very volatile, because this, because of that. No, the main reason is, have I done the job? Am I good enough? Do I have the necessary discipline? And is the job done? That's it. Ask yourself the right questions. So markets offer few opportunities. So this is another reason markets are not volatile. So markets offer few opportunities. It is difficult to capitalize on opportunities. No need to trade if the market does not offer many opportunities. And many traders will explain their counter-performance by the market situation. This is not my fault. It's the market's fault. I would say they are right, because myself, when the markets are not very volatile, it's not very easy to make money. But basically, that's the rule. We have to accept it. Sometimes we will make money, sometimes we won't. That's the rule of the game. So you have to adapt to the market and stop saying it's not my fault, it's the market's fault. No, the market is here. It gives you opportunities. Sometimes it doesn't give you opportunities, but it's in your trading plan. You have to understand it. You have to know that sometimes the market is interesting and sometimes it is not. Full point. The main reasons for traders' failure. Justifying failure with the reasons mentioned above is frequent. However, failure is often linked to the following errors: inefficient or non-existent trading system, laziness of the trader, for instance, no psychological preparation, limited capital. So these are the main reasons for traders' failure. And justifying failure, it's so easy to justify your failures. But the most important thing is to understand why you failed and try to find solutions. That's the main point. Take responsibility. These reasons and the reasons we talked about are sometimes legit, but they don't necessarily prevent some traders from achieving solid gains. Basically, you have 10% of people who will make it and 90% who will lose. You take whatever activity you want, you will find the same percentages. So basically the thing is, if I don't make it, I have to understand why. And is it possible to make it? And if yes, how? So the first step towards success is take responsibility. The trader must avoid accusing others and assume full responsibility for his actions if he wishes to succeed on the markets. It is really key.